And today on the Game of Loans podcast, I'm absolutely delighted to be joined by a good friend of mine, Daryl Norkett from LendWell. Daryl, thanks ever so much for joining me today. I know you're a busy boy at the moment, so your time is very much appreciated. Do you want to give the listeners a bit of a background on yourself, and then maybe give us a quick overview on LendWell, who I know are doing some great things at the moment?
Yeah, well, thanks for the invite, Sam. I'm delighted to finally get onto the Game of Loans podcast, which has got to be one of the best podcast names I've seen for a finance-related
I didn't
chat.
pay you for that.
No, I do like it. So I'm Daryl, and so I've been doing property finance for over a decade now, which you can't see me because it's a podcast, but if you could, you wouldn't believe that I could possibly have been doing it for that long with these youthful good looks. But I initially started at a very big bank at Barclays, so the big blue bank, and did some lending there. Great kind of technical training and sounding in kind of credit and how the market works and all that kind of stuff. And then I took what I felt was a big leap at the time, and this was kind of around 2015, to a littler bank called Shawbrook. And I remember kind of coming out of the big high street bank where you get institutionalized to a certain degree, I think, a certain sort of view of the world in these kind of bigger organizations with hundreds of thousands of people working there, and kind of thinking it was a completely different culture and a completely different lens on the world. So I kind of view that experience as having my eyes opened, actually, and that finance isn't just what the big banks do. There's this whole other world out there of banks doing things in different ways that actually perform really well and help investors and developers to do a lot more. So I had a great time at Shawbrook and spent my last couple of years there as head of products and markets, which is a really interesting job because I managed to kind of get involved in pretty much everything from what we did in the bridging market through to development, through to buy-to-let, through to commercial mortgages. Designed and relaunched every single product in the property division actually over a couple of year period to kind of bring things up to date. And the thing I probably enjoyed most about that, which is the thing I'm most passionate about, is I love finance, but I love property even more. So for me, what's so enjoyable about what we do isn't the pound notes, it isn't the technical bits about rates and security packages and this kind of stuff. It's what you can help people achieve. And that job was great for that because it was all about identifying where that kind of pockets of innovation were in the market and then trying to turn this kind of big oil tank for a bank around to a position where they had a product to actually help people take advantage of these kind of changing trends. So then kind of continuing the trend of only getting smaller as I get older, and I joined LendWell at the end of last year. So there's a lot of familiar faces at LendWell, set up by Stephen Johnson and Karen Bennett. Stephen was the deputy CEO at Shawbrook Bank and originally set that up back in 2012. Karen was the managing director of the property division, so led by far the largest part of Shawbrook's business. Worked with those guys for years. We've got some of the other team that we worked with through the same periods that worked with us at LendWell as well. And the kind of why we did it really was we just wanted to do something different, less corporate, more personal, able to get more highly involved with individual clients, individual brokers on individual loans because you're not dealing with such kind of big numbers. And just have a break from the corporate culture of running through committees and things like this and kind of get back into the grassroots really and the nitty gritty of lending and being at the cutting edge of the property market.
Yeah, do you know what, actually, as we were discussing off air, I was going to sort of jump in and start asking you about what you've been doing the last couple of weeks, and we'll do that. But I've made a note down here of, as you were talking about that, one thing that we certainly share is we do actually have a passion for the property side. We go to a lot of property networking events rather than just finance networking events. And you've just ticked something in my head there to ask you about. Firstly, I made a note about asking what the sort of the big cultural differences are between maybe working for or being in the larger kind of corporate style banking world to being an innovative lender like LendWell. And I suppose you kind of half answered it by talking about being able to be kind of, I suppose, more innovative and there being less layers to have to get through to make changes when you spot opportunities in the marketplace. And we certainly see a lot of those by going to these kind of networking events and seeing what property investors are talking about. But did you want to kind of elaborate on that a little bit?
Yes, I just think a lot of this is down to people and the size of organisations. So as you get bigger, it becomes harder and harder to manage a business. And I think that's true in every sector. It's not specific to banks or specific to finance. And I just think as you kind of scale up, you've got, you go from 10 staff to 30 staff to 50 staff to 100 staff to 150 staff, all the way up to 800 staff, wherever you get to. Every single one of those people plays an important part in the process. If they don't, they wouldn't have a job. So you need all of those people to deliver every loan that you do. But you can't kind of make an army of industry leaders and industry experts overnight. So what inevitably happens is that you need to bring in people who aren't experienced in our field, and you need to train them up. So that then consumes the time of your more senior experienced people, because they need to distill and share that knowledge throughout the business. So what you ultimately end up doing is saying, you know what, this isn't really scalable. So what I'm going to have to do is I'm going to have to set up processes. I'm going to have to set up systems so that someone can come into the business new and can be effective more quickly. And that's the only way you can grow really at any kind of pace and scale. And we're talking, this isn't just talking, modest growth. Shawbrook grew to, trading on the FTSE 250. So this is rapid growth into a big corporate. And it's the only real way you can do it. So there's some real positives with that, because with size comes some advantages around pricing, around kind of just firepower, financial stability. I think Shawbrook are an absolute credit to the market at the moment in that they're continuing to kind of lend with some tweaks and kind of stand by the property industry, which is what they've always done. But there's also some consequences for customers in that you don't always deal with the same person every time. You don't necessarily get to deal with a subject matter expert every single time. And sometimes processes don't work for whatever reason, or they break down on an individual transaction, and then trying to kind of fix those things and filter through that just becomes more difficult. And that's just a consequence of size. What we're trying to achieve with LendWell is, yes, we're hungry to grow, but not at that kind of not in that kind of way, not at that kind of pace. So I think if you can just pull the expertise and the decision making further to the front, have those people dealing with brokers, dealing with clients who really kind of understand how a deal works, you're able to kind of unpick some of the complexity that might stall a deal at a bigger, more institutional style lender. So it's really just about size, it's about people, and it's to an extent, it's about processes.
So, I mean, we mentioned there as well that there's obviously going to be certain, I suppose, what I always say to my clients is that there's usually whatever property investors want to be doing, sort of they're very innovative people, very creative people, and there's usually quite a big lag then between then the lenders catching up with those trends. I mean, it's taken lenders, I mean, I know not necessarily the right climate right now, but it's taken lenders a long time on the mortgage front to start getting their head around just serviced accommodation as an idea. But do you think then as well? Yeah, well, exactly. I mean, look, it's not a great time to be talking about service accommodation at the moment. I was on a Zoom call last night, which there was a big presentation about it, and I think it was a little bit outdated, unfortunately. But so from your position now, being at LendWell, do you feel a bit more freer to really get to grips with some of the trends that are happening in the market and then formulate opportunities to fill those voids maybe? I know obviously your main focus is the shorter term lending, but even in that particular sector, do you see that you're able to kind of make use of spotting trends and then creating ways of helping fund those opportunities better than, say, some of the larger organizations?
Yeah, I think so. You can certainly act more quickly. So, in a bank, you're probably looking at a 6-month process from kind of having an idea, or even maybe longer, because before the idea, you need people on, out in the field on the front line to spot the opportunities first. That then needs to kind of filter back into the office, and then you need to turn that idea into a product, which involves lots of committees and lots of due diligence. And banks need to do that because there's a big old book to protect, and you can bring it down with a relatively small number of bad loans. So that's how that works. With LendWell, so we're not a bank, so our funding relationships are either institutional or private. So with that comes nimbleness and comes speed, because a lot of these sort of funding opportunities, they're doing this because they feel that they want some of their capital invested into property because it generates them a return that blends their general risk across their overall portfolio. It's kind of what's happening. So there is an ability to be able to very quickly take an idea and take it straight to the source. So take it straight to the people with the money and say, look, the market's changing in this way. This is what the market needs. And this is how we think you can deliver those loans in a way that both meet customer needs, which is always the starting place, but in a way that's also safe and has some long-term sustainability. And if you can do that, you can literally, on a deal, deliver a loan outside the box on an individual transaction, let alone launching a brand new product. So there is that ability to move much more quickly. And I think as we come out of this current crisis, one of my kind of predictions for the future is that the banks will take a bit of time to figure out where they want their appetite to be as the market changes. So you need the market to change and property prices to kind of stabilise and tenant demand to stabilise and jobs to stabilise and all that kind of stuff. And then it will take the banks a while after that happens to get themselves in a position where they go, okay, this is what we think the market looks like now, and this is going to be our risk appetite. So it will definitely lag behind the recovery. Whereas I think with a smaller lender and the opportunity that we have at LendWell is I'd like to think that we'll be in a position to, almost be adapting our risk appetite live, month by month as these changes come in. And we're all over kind of tracking as much data as we can and getting as much market insight as we can to sort of see what's happening as we go along, rather than kind of waiting for a big event to change everything, if that makes sense.
Yeah, absolutely. I was gonna say on that, I love your use of the word nimble, because I think that's a really good way of describing actually kind of how smaller lenders such as yourselves can actually react to some of these things. And also thanks for sort of going into, I suppose, thinking about how things are going to be whenever this lockdown sort of starts to finish. But I was going to sort of pull you up on that and ask a little bit more about your thoughts on where the market might be leading. And I understand it's more sort of crystal ball territory now, but in terms of, I'm getting loads of different viewpoints. Some people are, the world is over, recession's going to be long term, property market's going to crash, and then we've got the alternative, almost polarized view of no, property's one of the strongest assets in the UK in terms of worldwide assets, will be absolutely fine. Where do you sit on that? Do you think that we are due some kind of property crash, or are we going to be absolutely fine, or are we somewhere in the middle?
Yeah, well, I think the classic answer is somewhere in the middle. I'm
set you up for that.
Yeah, I'm expecting a correction in values, if I'm honest. So it's so difficult to predict what that correction in values might look like, because I think in the commercial market, it depends how many businesses survive. So the government support package has been, pretty bold and pretty aggressive. So we're hopeful that most businesses that currently trade that are profitable, now there'll be some that were on their way out anyway. So, they were going to go bust, whatever. Might be blamed on Corona now, but ultimately it's nothing to do with it. And there'll be plenty of others that were really strong and successful before Corona. And it's about making sure that those businesses come out the other side in a position where they can continue to trade and occupy property, ultimately. If that happens, commercial property values will hold up, because it's all about rental yield, which is just linked back to how much demand there is for those spaces. I think on residential, I'm a little bit more pessimistic in the short term. I think much of the residential property market is underpinned by, people just living in their own homes. So there might be some people who kind of start working from home a bit and think, you know what, I'm going to do more of this, but I really need an office room or whatever it might be. And that might provoke some activity on the sort of optimistic side. But I think ultimately it comes down to jobs. People need to come out of this crisis with their jobs on pretty much similar earnings as what they had before. Then they probably just need a few months to kind of get over it. Go back to the pub for the first time, go out to eat for the first time, all kind of normal stuff that we haven't done and won't have done for a while, and kind of get their mojo back, really. And that's the point when people will think, I'm happy to borrow a bit more. I'm happy to take a bigger mortgage and move to a bigger house and all this kind of stuff.
Life's too short, yeah.
Yeah, life's too short. That will definitely happen. But I think we're going to have a period of time, and the golden question is how long, where that doesn't happen so much. And so during that period of time, I think it's inevitable that property values will fall, but then they will pick up again. The fundamentals are the bit that kind of underpins the whole narrative here that are really important. at the end of the day, we don't build enough houses to home the people that live in this country. Not really. So that isn't going to change, because people will, carry on having babies and all this kind of stuff. That'll carry on. It might be a boom possibly after 3 weeks.
I've heard some rumours of that.
Yeah, who knows, right? So long term, I think the future looks pretty good. We just got to navigate what will be some choppy waters for the next 3-6 months, whatever it might be, and just make sure that if you're an investor, you're making really good decisions during that period of time, so that you don't get yourself in a deal that causes you issues that then mean you can't take advantage of the opportunities that come from a recovery. Mm-hmm. So I think our position, at LendWell is, we're still looking at deals very much case by case basis. We are being very mindful about risk, and we'll continue to try and function during what is a very disruptive time. But really, where my mind really is right now is on planning for the future. It's kind of, when this crisis is over and there's a green shoots of recovery, we want to be there, and we want to be funding those investors as they come out of this and look to build and grow their portfolios. And I want as many of those investors and developers that are in the market now to come out of this absolutely fine and able to work with us and take those opportunities and grow their businesses too.
Yeah, absolutely. I mean, one of the things that I'm certainly seeing is, I do think that the short-term market, I think, has I was going to say dealt with this better. I think that's probably the wrong terminology. They've offered us as brokers more opportunities to find lending. Obviously, there are some that have just decided to shut up shop completely, and that's completely their prerogative. But one of the things we've struggled with is exit strategies. The sales market is basically dead at the moment for obvious reasons, and it's harder to look at what potential remortgage funding we could put in place for them. So have you guys found that being a bit of an issue as well? Obviously you want to lend as best you can, but it's sometimes hard to forecast that exit, which obviously, as we know, is the key to any deal, really.
Yes, I think there's a couple of points on that. So I think that the way the market's reacted so far is to reduce LTVs, and I think there's a very good reason for that. So every valuation report I've seen since the start of this is basically a valuation based on pre-crisis values, because that's where the comparables are. So there aren't any crisis values because nothing's been sold, nothing's been moving. We've had a complete kind of lockdown on transactional activity. So it's not like a normal slowdown where you have this kind of chipping away over time. People start discounting values and you kind of see a decline over a period of months. It's kind of like you're trading at one level and then the next stage is not trading. Mm-hmm. So what is the value of that asset? Don't know, is the honest answer. So the reaction of the surveyor community has been to say, well, look, the value before the crisis was X. However, please don't rely on that value because there's material uncertainty in the market at the moment because of the lockdown and the epidemic. So you make your own mind up, Mr. Lender. What do you want to do? So the reaction of those lenders is to say, well, fine. To sort of hedge our bets, if values do fall, then we'll only be at 60% loan to value on this deal when, yesterday you would have been at 75% loan to value on it. But I think that's going to change. So once the lockdown ends and transactional activity resumes, you'll start to see what is the short-term impact on property values. So does everyone pick up all the deals that they were trying to do before the crisis and then say, you know what, I picked that deal back up and I'm now going to complete on it on the same terms that I was looking at before? If they do, then arguably there is no impact on capital values because everyone's just trading on the same prices they traded from before. I don't think that's very likely. I think what's more likely to happen is that people pick up the same deal and say, I'll do this one, but not so confident about what my sale looks like in 6-12 months time, and not so confident about how quickly I'll get good tenants and all this kind of stuff. So I'll do it, but I want a bit of a discount on it. And then the golden question will be what that discount kind of settles at, and that will then impact on what property values look like for the rest of the year. I think, but once you see that market mature and kind of come to the fore, there'll be like a new normal. There'll be a post-crisis new normal, and loan to values will go back up again, but valuations might come down. Mm-hmm. So we'll get to that point. I'm pretty confident in the short term, but it needs a lot more transactional activity to happen.
Yeah, it's funny, isn't it? It's always the way I see it is it's always simple. When there's a problem with the market, it's always when there's a differentiation between the expectation of the vendors and the buyers, and that's pretty much it's as simple as you can get it, really, isn't it? So I think you're right, and I was actually going to go on and ask you about obviously seeing some of the changes that have happened in the lending market, including lower loan to values, higher rates, and various other bits and pieces. What have you guys done at LendWell, and why do you think? I mean, you've spoken a little bit there about loan to values, but I'm getting a lot of people are just changing their criteria because they're too busy. I don't necessarily just buy that. I think that might be a small percentage of the reason. But from LendWell's perspective, can you understand some of the changes that have been made, and what sort of changes have you made over the last couple of weeks to your sort of, I suppose, standard sort of criteria in terms to fit within that?
Yeah, it's a really interesting point. So every lending business is managing different challenges at the moment. So the first thing that affects all of us is valuations. So pretty much it is extremely difficult to get any valuations done right now. So the sort of knee-jerk reaction after the lockdown was announced last week was, let's try and carry on. So some valuation firms tried to carry on, some didn't try and carry on. And then I can't remember what day it was, but there was one day later last week when the housing minister came out and said, you know what?
I think it was Thursday.
Thursday.
Yeah.
I'd rather the market stops right now. And then a lot of valuation firms kind of felt like, okay, we're sort of being told here what to do. We're sort of being told not to carry on. So it's very difficult to practically deliver a loan at the moment unless you've got automated valuation models set up, so desktop valuations. And there are a handful of lenders who are using them. A couple of the bigger ones who use them aren't lending at all, so it's not really helpful to the market. Some of the others kind of are here and there. But what's kind of difficult on that front is that it's caught a lot of us on the back foot, really. So it's quite difficult to sort of say, all right, we're in lockdown, so let's go and set up a load of desktop valuation processes and systems. So having been involved in a project setting that same thing up at Shawbrook, there's quite a lot to think about, quite a lot to deliver. It's very difficult to deliver it very quickly in a kind of safe way. So it's quite hard for lenders to just kind of say, all right, we didn't do desktop valuations, but tomorrow we will. Because it changes their whole risk profile, and there's a lot of other stakeholders to managing that. It might be your funding lines, it might be your own private investors, it might be your risk committee at a bank, all this kind of stuff. So it's not
that does seem to be one of the big misconceptions with investors when we're trying to explain the situation with sort of desktop valuations, that this isn't just something that can happen overnight. It seems to be a question I'm getting a lot of, why can't they just move to this? It's not as easy as that, is it? So I appreciate that.
No, and they're not well understood either. So most people working in the industry just don't understand where the values come from, how they're supported, and every lender needs to be absolutely confident in that valuation. That is your security. It's the bedrock of your business. So you need to really get into the nitty gritty of how the models create the values in the first place to kind of get your head around it. So there's quite a lot of work that goes into that. So I think post-crisis, one of the consequences of this will be that actually more lenders will use desktop valuations. I don't think they will during the crisis, but I think afterwards they will, because people will sit back and think, you know what, we've got caught on the back foot there. What if something like this happens again? What if the virus comes back? All this kind of stuff. Let's set something up so that we can continue to trade. So I think in the future we'll see more use of desktop valuations, but I just don't think we'll see a knee-jerk reaction in the short term. So the other kind of big changes is really managing your stakeholders, which I kind of touched on briefly there. So if you're a bank, you've got to worry about your great big enormous book, which is ultimately the balance sheet of your business. So if you've been lending for 10 years or more, then you're going to have a lot of loans. Those loans have been written in different parts of the cycle at different times, different interest rates, different types of borrower, all this kind of stuff. And it's inevitable that some people will struggle to pay their mortgages back. So there's a lot more activity in the banks just around, okay, fine. So how do we support those customers to make sure that they can take advantage of things like mortgage holidays and things like this? And also, what do we think the impact is going to be on our kind of book and our arrears and our bad debt later on? So there's all that extra work to do, whilst you've also got the challenge of finding it very difficult to actually write any new loans operationally. And that's a really big effort, because lenders' operations teams are not set up to deal with hundreds, potentially thousands of calls for mortgage holidays. In fact, they might not even have a system for mortgage holidays at all, and have only had to come up with it because of what's happened just recently. So I don't think we should underestimate the kind of gargantuan effort they're having to go through. And that's the reason why, you know, some of them have stopped taking new business. Ultimately, they just cannot cope, and they've decided to prioritise their existing customers. Which, if I was there and I was still in that seat, I'd make the same call. In our world, it's really for us, it's kind of, apart from the valuation issue, it's just really around trying to keep an eye on where we think a sensible risk appetite is. So we spent a lot of time the past couple of weeks trying to kind of get behind exactly what we think is going to happen in the market. And, you know, rather than just say we don't want to participate during a crisis, to sort of say, well, how can we safely participate during the crisis to help some people out, and do some deals where there's sensible deals there to be done. And there are still a number of people that are committed to really good deals, so they need solutions to be able to kind of see those through.
Mm-hmm.
And then the sort of second part of it is just kind of staying really close to what's happening in the overall funding market. There's lots of funding lines out there. There's lots of kind of hedge funds, pension funds, private investors, all this kind of stuff. They're all individuals. They all have different views. So, you know, we spent a lot of time making sure that we know we kind of keep our finger on the pulse of what's going on in that market. At the minute, there's a bit of a flight to cash. So all the funds want cash rather than assets of any particular type. And in the short term, that is problematic, which is another reason why some lenders will have stopped lending. But in the long term, I actually think it stands property in good stead, because what will happen once the dust settles is that those funds will kind of say, all right, we need to deploy this cash now because it's safe to do so. We're back in a normal trading environment. What do we deploy it in? Stock market's been really volatile, so I don't think people are going to kind of go all in on stocks. They haven't done for a long time. I don't think that they will again. You can't really use your cash in terms of savings and bonds very effectively because we're in a super low interest rate environment now. So I think a lot of that money will flow back into property, you know, and lending conditions will be pretty good quite quickly, is my prediction.
Yeah, do you know, I was asked by a client last week, actually. They said, what's one of some of the key differences between what's happening now and what happened sort of 2008, 2009? And I said, well, the big one is that this isn't an economic crisis at the moment. It's a health crisis, and so it's a social crisis, and as a result, there are going to be economic knock-on effects to that. But effectively, once the social crisis is kind of sorted in a way, and we're, you know, lockdown's over, the economy can be allowed to go kind of back to normal. So the other big one is kind of what you picked up on there, and that's liquidity. There's probably more liquidity now, or at least there was a couple of weeks ago, than maybe ever in since records began when it comes to sort of the lending market, and certainly more lenders in the UK than probably the rest of the Europe put together in terms of choice. And I said this to them. I said, one thing you've got to understand is, yes, there are a lot of lenders that have decided not to lend, but there's still enough available to be able to take action. If you were in France last year and wanted to buy a house in Paris, and you needed a mortgage, you had the choice of probably 4 banks. Here, in the same position in London, you would have the choice of 50 banks. You know, that's on a normal day. So if you cut both markets by 75%, we're still better off now than France, Germany, Spain are in a normal market in terms of choice. Yes, okay, that there's fewer products than there used to be. Loan to values have been clipped, but I'm still seeing certain lenders offer 75% mortgages. Yeah. The short-term market, as you've alluded to, probably slightly different. I think the highest I've seen is probably 65, 70%. But it still means that the market can move. And this is what I was going to ask you, actually. Realistically, you know, we can all, you know, we can have a bit of a blue sky thinking style discussion on it, or we can kind of be realistic. From your point of view, what can the lending market do, including the surveyor market and all the other people that are involved in a transaction? What realistically do you think can be done over the next couple of weeks to keep the market actually moving, to stop it from actually grinding to a complete halt?
So I think the reality is that transactionally it will grind to a halt. So it's all about what you can do in the short term to make sure that as and when the lockdown ends and you can travel again, that transactions then happen really quickly that people want to do. So I think it's all about engagement with lenders now, getting as much of the underwriting done up front. So most of the lenders' traditional processes would be to kind of have a quick look at the deal, get some terms out, get a valuation, then really get into the nitty-gritty of underwriting after the valuation's back. So we've certainly would change our process to adapt, and pretty much seen it from kind of a lot of the other lenders as well, where it's kind of like, okay, look, we can't get a valuation right now, but we can underwrite it. Our staff are working from home.
Mm-hmm.
Operationally, lenders still function. So why not kind of underwrite deals now and say to people, look, this is what we can do subject to valuation. So I think that's one thing that lenders can do in the short term. And also I just think that it's probably easier now than in normal times to get hold of some of our professional partners. So not just the surveyors, but also people like the solicitors. So if you've got to deal with a particular legal challenge, rather than kind of wait until the end of the transaction when you're there, now's quite a good time to say, well, actually, can we get hold of the solicitors? Can we try and tackle some of this stuff head on that we know is a particular quirk or particular legal issue with a certain property, and kind of get this done up front? So there is things that can be done in the next couple of weeks. And I kind of view it as just building all this kind of pressure. And then hopefully when the lockdown ends, it's kind of like popping a cork, and those transactions that are there and ready to wait and ready and waiting can just go straight away.
Yeah, I've said similar things to my clients actually. If there's something being done now, let's just get it done. Get applications submitted, get as much done as we possibly can. And we are seeing more and more lenders are saying exactly the same thing as what you've just said, Daryl. That if we get everything done, we can kind of tidy the deal up subject to val, and then it's just literally a case of, like you say, popping the cork. I've not heard that one yet, but I like it. Once we're all over, get the job done. But I tell you what, look, I know the coronavirus is taking up pretty much everyone's thoughts at the moment, so it's nice to sort of maybe come away from it a little bit. We were talking earlier on about LendWell's ability to adapt to new trends in the market and offer products that are going to be able to facilitate those investors taking on something a little bit different or a little bit innovative. Before we sort of entered the coronavirus, what sort of trends were you kind of seeing in the market from a property investor point of view, whether it be in commercial or residential? Because presumably once we're done, those trends will take off again. So if you're an investor and you're sitting at home and you're listening to this and you're thinking, what could I be planning for the rest of the year? Where do you see some innovation in the market and or some trends, certainly towards the beginning of this year?
Yes, I think the first thing on that is, and no one knows the answer to this yet, but when we come out of this, there's going to be new trends and there's going to be new innovations. So it's part of my kind of thinking at the moment is making sure I kind of stay as close as I can to as many people as possible, so that we can spot those early and do something with them early. But the bit that I kind of have been quite passionate about over the last 6 months or so is just, we sort of felt there was a bit of a gap in the market for how you fund what we termed light development deals. And what we really meant was that we found that if you're doing, if you're building a block of 50 flats, or, you're building kind of a row of houses or something like that, there's quite a lot of really good development finance options out there, particularly with the specialist challenger banks. So that market where you're kind of borrowing a couple of £1 million or more was quite well served. If you just wanted a kind of really quick bridging loan to buy a property, put in a new kitchen, new bathroom, and then whack it onto a mortgage, there's quite a lot of products out for that as well. So we thought that market was pretty well served. But where we felt the gap is that just those smaller development schemes. So, you might be buying a property for 500,000, say, and spending 200,000 on it. So what you then find is that your development lenders of the real kind of caliber that people want to go to kind of say, a bit small for us, not too interested. And then your bridging lenders kind of go, yeah, we'll do that. We'll give you 75% of the 500 purchase price. Now that's great, except when you think about that in cash terms, that's quite a hefty deposit. You've got stamp duty, you've got legals, you've got professional fees. And actually funding £250,000 worth of work out of cash is a real stretch for a lot of people. So one of the bits that I still think this would be important moving forward is just around kind of serve that part of the market where you've got these smaller assets, smaller development opportunities that might be less pound notes, but quite often we're actually better margins, better return on money, better profit on GDV, better profit on cost. And also the other thing I really like about that market is quite a lot of the time you've got more exits in mind. So if you're building 50 houses on a big new scheme, to be honest, you've got sale or sale. You're not going to rent them all. You might rent some, but you're not going to rent them all. So you're quite committed to one particular kind of trajectory and track. Whereas in some of this smaller refurb conversion stuff, you could sell it, but equally they usually lend themselves to being investment assets as well. And particularly kind of where you've got commercial property being converted or semi-commercial property being converted, where you might retain an element of commercial space. So was really keen and still am really keen on those sorts of opportunities. And I think they'll still be there as and when the market comes back. And actually, one of the trends in that space was retail with uppers. So a lot of deals where, you know, you might have some storage space above a retail unit where we can convert that into flats reasonably straightforwardly. And then you might have a large retail unit on the bottom. So there are lots of deals done where it was kind of like, okay, well, let's have a smaller retail space. Let's maintain a retail shopfront because that's what people want to see on the high street. It's what the council want to see on the high street. But let's make that work better for the retailer because I'm bringing his rent down, I'm bringing his rates down by creating a smaller space. It doesn't need to hold stock anyway. All his storage is empty. You know, that situation is coming up quite a lot. And then on an investor developer side, well, I'll convert the rear to a flat, create some great capital value, and then I've either got a long-term investment asset or I've got a viable property to sell for a decent profit. And actually what we might find after the crisis ends is that there's more retail space available or more retailers who would be happy to downsize. So I don't think that will go away. I actually think that might accelerate and we'll have even more opportunity in that space.
Yeah, do you know, I was going to say, I was literally talking to a client earlier on today about changing in the commercial market and certainly smaller spaces, whether that be retail, office, you know, no matter what, it's potentially there could be quite a good gap opening up in the market for those that had a niche in I suppose splitting up those kind of units or creating smaller units, because like you said earlier on, more and more people are working remotely now. Do we need as much office space? Do we need as many people in a retail space? You know, a lot of people have online stock, as you say. You know, you've got the Argos style way of doing things, but actually there's nothing in the back. It all gets delivered to you online. So I think you're right there. You know, there's certainly an opportunity, I think, to do exactly what you're saying and creating these smaller commercial spaces, which I think. Yeah, as you said, I don't think that's gonna change just because of this crisis. If anything, it's going to accelerate because of it.
And the behavioural changes that you see will be really interesting. So again, I haven't got a crystal ball. I don't know which way this will go, but I'm really, really confident that some of the changes we're making to our day-to-day lives will stick.
Mm-hmm.
So, you know, what does that mean for the property market? So does that mean for residential house builders that actually having an office space in a property becomes much more important than it is at the moment? You know, I don't know, but maybe it does in the future, and that's kind of an extra consideration in that market. And equally in the commercial space, what does that mean about unit sizes? Does it mean actually, you know, serviced offices become increasingly popular because bigger companies take smaller spaces because, you know, people only go in 2-3 days a week, whatever it might be? Does it mean you don't need as many meeting rooms because people are more able and happy to do kind of virtual meetings via Zoom and this kind of stuff? You know, I don't know which ones of these will stick for the long term, but I know that some of them will, and it's all about staying close to those ones.
Yeah, absolutely. I think I've said this on the podcast a couple of times, and I've said it to people in general that you know, whenever there's a period of crisis, it kind of forces your hand with certain things. And you know, I did when I did my history degree, we did a lot about the wars and how medical advances happen, technological advances happen. It's because, you know, those changes were sort of thrust upon you. You had to make those changes, and now on a much smaller scale, obviously, but employers are being forced, whether they had ideas of creating some kind of remote access way of working anyway, or whether they weren't, everyone is having to work from home. No matter what your job, you're having to work from home. And I think it's just proving to a lot of people that the jobs that people thought couldn't be done remotely can. You know, on maybe when we're just talking about our industry, you might say, okay, well, actually, we don't really want underwriters working from home. They're dealing with secure information. We need those people in the offices. Well, quite clearly, they can do their job from home. Systems can be put in place to make sure things are secure. You know, we have the technology available. It's just utilizing it in the right way. And I'm hoping that that's going to be a major positive coming out of this. You know, Tim Ferriss wrote the 4-Hour Work Week years and years and years ago, and actually finally, you know, what he prescribed as the best way of living your life is kind of coming true now that people are learning. And I'm thinking even more widely than that, I read something on Facebook yesterday which said there are a lot of people that are disabled that don't get jobs because they thought that access to a building, an office, was required, but actually now we realize that you don't. So, those that maybe wouldn't have got jobs previously might now get them because the opportunity to work remotely might be greater. And obviously with the Zoom technology that we have, this call is a prime example of that. We can work internationally much easier, and the world might just become that little bit of a smaller place as well.
And I think it's an absolutely fantastic point. So I remember recording a podcast, with a former colleague, a really good friend of mine, a couple of years ago, and he hired out a space in like a media studio with a mic and everything. So kind of sat in the room and recorded it, and I had a great time. It was cool. But do you need to do that? I don't think you do. And one of the things that we're doing within LendWell that I'm quite excited about is that we're dedicating time each week just to look at different bits of tech. So kind of normally all this stuff kind of gets swamped up by day-to-day life and day-to-day business. But I think it is important to use some of this downtime as productively as you can. And there's so much technology out there already. It's not a case of waiting for it. It's the actual opportunity is just to make the most of what's already there. And very few businesses are.
Absolutely.
So that's going to be another kind of cutting edge as we kind of come out of this crisis and look to kind of grow again.
Yeah, do you know what? I was talking about this last night. I did a presentation last night about how to use social media for your business on a Zoom call in front of 50 people, 50 property investors in Glasgow. And I told the story of, actually, I've always had kind of media, I think, in my blood. I really enjoy it, and I enjoy this medium of discussing things and getting content out into the atmosphere and spreading knowledge. And I did, when I was doing my master's degree, I actually had a radio show. And when I was thinking back to being in that studio, all the equipment, all the different computers, about 5 laptops, there was about 20 different mics and all these different stations, wires absolutely everywhere. And we felt that at the time, I mean, this was 2010, it was necessary to just to record something that is pretty much the same as this, let's be honest, required all of that equipment. Okay, it's probably slightly better sound quality and all that sort of stuff, and we had the ability to edit things a lot easier. But ultimately, in doing this, you're sitting in your home, I'm sitting in mine. I've got a mic, USB chucked into the side of the laptop. We both got our cameras on, and away we go. And it is amazing when you think of it is actually that simple to create something like this that can can share this kind of information out into the atmosphere. It's amazing how far we've come, and I think this time is just kind of, I suppose, realize that people are realizing the technology we have a little bit more and making use of it because they're being forced to do so. But we have changed a little bit over those years, but it's just funny the difference. But look, Daryl, we could sit here, we could sit here and chat for hours and hours. I know that you're a busy guy and you've got a lot to be getting on with. So look, I just want to say thanks ever so much for coming on and doing this. It's been a real pleasure having a chat with you. And I know that, you're a very knowledgeable guy when it comes to this stuff, not just as being a kind of a BDM, you actually understand the cogs of the business and the lending world. So I really appreciate your input. But before we head off into the sunset, how can people get in touch with you, whether it's just to discuss any things that we've been talking about here or get more information about LendWell? I know you're pretty active on LinkedIn, but what's the best way of people getting in touch with you, Daryl?
Yeah, so firstly, thanks for having me on, Sam. Absolute pleasure to spend a bit of time having a chat in these days of isolation.
Absolutely.
So yeah, you can find me on LinkedIn. Probably easiest place to find me is on our website, which is www.lendwell.co.uk. More than happy to talk to anyone. Spent a lot of time recently just talking to people who might have any worries or concerns about existing mortgages or existing development sites, that kind of stuff. Always happy just to give some advice. Help where I can, and equally, feel free to connect on LinkedIn, and I'll try and put some content out on there now and again.
Perfect, great stuff. Well, thanks again, Daryl, and look, stay safe. Don't go out to Sainsbury's too often, will you? And we'll catch up again soon. Perhaps we'll get you back on once all of this lockdown is over, and we can talk about some positive stuff in the future.
And how many predictions I got wrong.
Absolutely. We'll play this back and we'll see how well you did. Awesome. Thanks so much, Daryl, and we'll catch up again soon.
Cheers, Sam.
Cheers, mate.